Bitcoin crash and ETF outflows, how institutional mechanics drive volatility. This is February 5, 2026. Bitcoin plunged to $63,300, wiping billions from crypto markets while spot Bitcoin ETFs recorded massive outflows. Over the past 3 months, ETFs saw roughly 18 billion redeemed, led by the largest ETF sponsor, even as institutional purchases occurred on-chain. That disconnect matters. Two markets, two dynamics. ETFs and derivatives trade as paper exposure, on-chain markets handle actual coin transfers. When large ETF custodians redeem, custodians move real Bitcoin to exchanges, where it is sold into available liquidity. Large, time transfers during low liquidity windows can trigger rapid price drops and cascade liquidations in leveraged positions. Documented patterns. Large custodian transfers to exchanges preceded major price drops on multiple dates. A recurring intraday pattern, aggressive selling shortly after the U.S. market open, around 10 a.m. ET, followed by gradual recovery, consistent with high-frequency execution targeting low liquidity windows. Coordinated, concentrated exchange sales have occurred across multiple venues in short time frames, producing swift, large declines and triggering liquidations. ETF trading volume can spike on days with large outflows, indicating active buyers on the other side while redemptions occur. Consequences and mechanics. ETF redemptions increase spot sell pressure, timing sales into low liquidity periods amplifies price impact and forces long liquidations, which further depress price. Simultaneously, on-chain accumulation in other regions can absorb coins, widening the disconnect between paper and physical markets. Mining supply remains constrained since the halving, so persistent structural outflows versus limited new supply can intensify dislocations. Probable near-term scenarios. Capitulation bottom, higher probability, deep fear triggers capitulation, retail sells, and long-term accumulation resumes, allowing a rebound in weeks. Deeper correction, material probability, macro tightening and liquidity stress drive lower prices, forcing leveraged holders to sell. Sideways consolidation, lower probability, extended range-bound trading while institutional flows and macro drivers find equilibrium. Practical guidance. Physical holders, self-custody, hold and ignore intraday noise, long-term ownership avoids being victimized by paper market mechanics. Leveraged traders, reduce or remove leverage immediately, liquidations can cascade fast in manipulated intraday moves. Spot accumulators, dollar cost average, accumulate across multiple trenches rather than timing a presumed bottom. Portfolio risk. Reevaluate position sizing, treat current volatility as a structural regime where paper and physical flows diverge. Bottom line, current price action reflects structural ETF redemptions and timed institutional execution interacting with constrained new supply. That creates acute intraday vulnerability and amplified liquidations. Understand the custodial transfer and redemption mechanics, avoid leveraged exposure, and use measured accumulation if your horizon is long.